Hi, thanks for joining me. My name is Randy Pertler. I got a little introduction slide in a second here, but just wanted to let you know that most people that are watching this video are watching it for one of three reasons. Either they want to partner with us, they want to learn how to become trained by us, or they want to learn how to help us expand. Here's just a brief introduction about myself. I was a VP of sales and for some publishing companies, went into investing in real estate, became a full-time investor. I've done about 100 deals between the wholesale, fix and flip, subject to properties, and so forth. We're going to just briefly go through a type of investing that our group really kind of focuses on and give you some examples of those. The first one, wholesale deals. This is an example of a wholesale deal that I was able to do. I got this property under contract for $50,000, and then I was able to assign that contract for $4,000. So the end buyer paid $54,000, which was a great deal for them. However, for me, it was even a better deal because in just a matter of a few days, I was able to make $4,000 with none of my own money, none of my own credit. So people ask, in real estate, is that really possible? Can you really do a deal with no money and no credit? Well, this is proof the answer is yes, but you need to know what you're doing. Flipping turnkey rentals, that's something else that we do. When we what I mean by flipping a turnkey rental is that we buy the property, we rehab it, we get it rented, then we flip it to investors that are looking for deals that they can buy and immediately after close start making money. So they want the property already rented out so that they know what their ROI is going to be. So here's a case of a turnkey rental. We bought this for $37,000. We put only $3,600 into it. So we had a little bit over $40,000. In less than 30 days, we closed on it and sold it for $54,500. And that net us a profit of $13,900. Now that's not enough to get rich on, but when you think about that done over just a 30-day period, that's a 34% return on investment during the project. And if you annualize that over a 12-month period, the annualized ROI would be 416%. Here's an example of another no money in deal, no money, no credit. This is called a subject to acquisition. This subject to acquisition is one that I did with no money down, and here's how it worked. This particular property, the homeowner didn't want it anymore. They were moving out of state. So they were looking to get rid of it, but they didn't want to be a landlord either. So I negotiated with them. This was actually brought to me by a wholesaler. So I paid the wholesaler $1,500 for bringing me the deal. There was no down payment at all, and the closing cost was only $52. That was only the recording fee. So see this garage right here? We actually did the paperwork in this garage, and was able to get the deed and everything recorded to their satisfaction. It's recorded at the county courthouse. And this is rented right now at $1,800, so it's rented at $1,800. The principal, interest, taxes, and insurance all is $862 a month. So if you subtract that out, the positive cash flow every single month is over $900, and that's really just $1,500 paying the wholesaler fee, plus the recording fee of $52. So that's called subject to. I've done these where I haven't paid any wholesaler fee, but this is an example of the most recent one. Single family homes, rentals, we do those as well. This is an example of one that I did after refinancing with a small bank. They actually came to me and asked if I wanted to buy any of their foreclosed properties. So I negotiated with them. I had just done a flip in this neighborhood, so I knew the numbers pretty well. And I said, listen, I'm willing to give you $40,000 for this property. However, I want you to finance the full $40,000. I'd also like you to finance the rehab cost, which is $29,100. So that comes out to $79,100. Then after we've bought it, rehabbed it, and rented out, we'd like you to refinance this property because I want to hold on to it. And we'd refinance it at 75% of the LTV, that's the loan to value. So what happened in this particular scenario is when we got done with the property, it appraised at $120,000, and at 75%, it's $90,000 on the refinance. So we were at closing, we got a check for $10,900. So no money in, no credit in, a check back for $10,900, plus we have a property that we're now cash flowing, and we got a renter in there immediately at $1,400, and minus our loan that we have and all the taxes, it's still netted about $450 a month. Here's an example of a multi-unit rental, 3-unit building. Bought it for $21,000 through an auction. We put about a little over $30,000 into it, so we only have $51,000 into that. Again, it appraised. We got the same deal where we had a 75% loan to value, and it appraised at $160 immediately as soon as we got this done. Even though we only had 51 into it, it appraised at $160, so we got a loan at $120. If you subtract $120 from how much money was put into it, we got to put over $68,000 in our pocket. And what's great about the $68,000, it's not taxable because technically it's not income, it's a loan. So we're able to put $68,000 and then have a loan that our renters pay back for us. So this is not taxable income, and it nets about $650 a month. So this was a very profitable deal. That's an example of a multi-family rental. This would be an example of one of our fix and flip or rehabs. And the only difference really between the two is rehab is much more extensive. So when you do a rehab, then you're looking at, longer time periods, you're looking at more money into the project. But this is a recent one that we did. It was only on the market 7 days, by the way. And we purchased it for $70,000. We put $85,150 into the project. When we subtract out the holding costs, taxes, paying the marketing fee, which is the broker fee, that holding cost came to $16,850. We sold that property, again, in 7 days, we sold that property for $237,000. So the net profit on that was about $65,000. And if you look at the project ROI, is about 42%, and the annualized ROI, since that only took 6 months, if you annualize it, it's 84% return. So why real estate? Why do people get into real estate? Well, a lot of times they look and they evaluate their own retirement situation. After Americans have been putting into 401ks, pension plans for years and years and years now, we have some results on that. Now at age 65, how are people doing? Well, at age 65, this big chunk here is the biggest percent, and this 74%, or I'm sorry, this is 36% of people still have to work at age 65. So even though they've saved for retirement, at age 65, 36% are still working. A bigger chunk than that is actually the 54% of the people at age 65 that are dependent on others. That means that their sons, daughters are taking care of them. They don't have the financial means to take care of themselves. If you look down here, 4% are financially independent. That doesn't mean wealthy, that just means that somebody doesn't have to support them. And then if you look down here, that very skinny number, that's 1%, that's wealthy, considered wealthy. Well, everyone's trying to achieve the American dream, but what's unique about this 1% that's wealthy? Well, if we look at the numbers, the 1% that's wealthy, 74% of those people are business owners and or real estate investors. So when I looked at this, I thought, well, why reinvent the wheel? Business owners, real estate investors, that's much more than doctors and attorneys, CEOs and presidents of companies, salespeople. Down here, even lottery people inherit money. So the 1%, believe me, not much of that is lottery. So if you don't have wealthy parents, you're probably not going to fit into this 1%, because that's the biggest chunk, is inheriting money. So let's look at why real estate. Real estate we call the ideal investment. And that's an acronym for income, deductions, equity, appreciation, and leverage. So let's take a look at each one of these. Income is pretty easy to find or to grasp. We show you some examples of income. That could either be through a rental property or through flipping a property. So income, I think everybody kind of understands how real estate potentially can make you income. So let's spend a little bit more time on the other. Deductions is very important. You're never going to really accumulate wealth unless you have a tax strategy. The deductions that real estate affords you is a tax strategy that will help you tremendously in building wealth. As a W-2 employee, someone that works for a company, you have a few tax write-offs, but the amount of tax write-offs that you have, legal tax write-offs, is about 17 that you could even possibly qualify for, and most people only qualify for 2 or 3. But as a business owner and or real estate investor, you can qualify for over 400 tax deductions. So deductions is huge, and it's why real estate investing is so exciting and a way to build wealth. Equity. Equity can be achieved a couple different ways. One is appreciation, and we'll talk in a minute. But equity, kind of in its simplest form, when you look at rental property, if you financed a rental property and you have a mortgage, let's say at $100,000 on a property, and let's say it's worth $120,000, every time you collect rent during the month and you're using that rent to pay off the mortgage, you're building up equity because the balance of your loan keeps going down. Even if the property value stays the same, you're building equity within that property by paying the mortgage down. So that's equity buildup. Appreciation. Now most people are scared of appreciation when it comes to real estate because you should never bank on appreciation. It's just icing on the cake when you get it. So appreciation is when the value of the property goes up. There's forced appreciation. In other words, you can do things like rehab that increases the value. That's forced appreciation. Or you can just have natural appreciation in a market. Now we had some depreciation happen started about 10 years ago. It started to go down, but the market did rebound. But if you look at all the statistics over any 25-year period, real estate has gone up on the average of 5%. So it's been consistent. Just look at any 25-year period, and that's important because with real estate, you can leverage and make this appreciation number even greater. Let me give you an example. Leverage means that it's not all your own money. I gave you some examples of subject to acquisitions and a couple other type of acquisitions. But let's just say at a rental property, for an example, if appreciation goes up 5%, then let's use that number as our baseline number. So leverage means that you can get financing for it or leverage somebody else's money. Let me give you an example of something that's difficult or almost impossible to leverage would be stock. That'd be another investment if you want to compare real estate to stock. Let's say you had good income, a good job, and good credit, and you go into your banker and say, listen, I've got this great tip on this stock. I want to put in $20,000, I want to borrow, you give me $80,000, I want to borrow $80,000, and I'm going to invest $100,000 in this stock. Not too many bankers are going to say yes. In fact, I don't know any of them that would. So it's difficult to leverage another type of investment. But let's look at the same scenario. Let's say you have a good job, good credit, good income, and you go into that same banker and says, I've got this property that's worth $100,000. I want to put in $20,000, 20%. I want you to finance the 80%. Does that happen? Yes, it happens every day. And that's leveraging. Now let's look at combining appreciation with leverage. So that $100,000 property, again, if it went up 5%, that'd be $5,000. So on a $100,000 property, every year it would go up $5,000, okay? If you leveraged it, do you have $100,000 into the project? No, you only have $20,000. So if you have $20,000 in and you're getting $5,000 out every single year, that's not 5%, that's 25%. 5,000 of 20,000 is 25%. So that's how leverage can really accelerate that appreciation number. And that's what got me excited about real estate again, is looking at that appreciation, because people say, oh, 5%, that's nothing, I could get that in the stock market. But when you leverage, it's combined and it's maximized. Okay, so as I mentioned before, the first slide, the reason you're watching this video is because you're either interested in maybe working with us, which could be a partnership arrangement. You could be interested in getting trained by us. That was the second thing. And you can talk to the person that shared this with you about how to train with us, but also expand with us, because we have a unique opportunity in our group that we pay people to help us expand. And we call this the Earn While You Learn program. So we pay referrals to people that want to become part of our group and part of our, take our education courses. We pay between $500 and $10,000 for referrals. It's a very, real estate investing training is a very lucrative business. And we want to share that back to the people that referred it. If you look at what's happening out there in the industry, all these different guru models, people that are in various parts of the country, they advertise either on late night TV, or they might be on the internet, flip this house, flip that house, flip this, or whatever. You're seeing that over and over again. Well, they spend millions of dollars on advertising into a market, and then they come in and they do these workshops. And I'm not saying that's necessarily bad, but who gets the advertising dollar? Well, that's, Google and all the internet providers and the TV stations. We've got a different model. This is when we bring people into our education group, we give back to the community that we're involved in. We give back to the members that are already a part of us, and we pay them very handsomely for referrals. So these programs, again, oftentimes they can go up over $70,000 for these programs. So we think we've got a little better business model, and it's something that you're going to like to find out about. So again, as I started out, I wanted to give you a little bit of information, and then if you're interested, you can contact us. So again, we're looking for people that want to partner with us on some of these real estate deals that we showed you. We're also looking for people that want to be trained by us. We have a very extensive training program, a mentoring program that I think you'll really like and be able to accelerate your investing working with us. And the other thing is helping us expand. If you're interested in that part of the business, let us know and we can certainly get you information on there. My email address is randypertler@onlineowners.com. This is my cell number here, my direct cell number that you can contact me or text me at. And also, if someone shared this link for you or to you and they wanted to tell you about working with us, please get back with the person that shared this information with you, and they can give you more information on how to start with us. Okay? Thanks for your time, and thanks for watching the video.